In this sprawling metropolis of the global economy, amidst the ebb and flow of fortune and crisis, stands a silent guardian, the central bank. More than just a building of stone and steel, it is the conductor of our economic symphony, tasked with maintaining financial stability and steering the nation through turbulent waters. But what are the tools at its disposal? How does this institution wield its immense power to keep the complex machinery of the economy running smoothly? One of the most powerful instruments in the central bank's arsenal is the interest rate. Imagine it as a master control dial for the entire economy. When the central bank raises this rate, borrowing becomes more expensive. Suddenly, the dream of a new car or a first home feels a bit further out of reach. For consumers and businesses, think twice before taking out loans to expand. This slowdown in spending helps to cool an overheating economy and keep inflation in check. Conversely, when the dial is turned down, borrowing becomes cheaper. An invisible signal is sent out, encouraging people to spend and businesses to invest. Consumers eagerly sign for mortgages and car loans. Factories hum with new activity, and the economy gets a much-needed jolt of energy. It's a delicate balancing act, a constant adjustment, to keep the economic engine from either stalling or redlining. Next, the central bank engages in what are known as open market operations, more subtle but equally potent maneuver. Picture the central bank as a major player in the financial markets, strategically buying or selling government bonds. When it purchases these bonds from commercial banks, it's like injecting a powerful dose of liquidity directly into the financial system. Money once locked up in these securities flows back into the bank's coffers. With more cash on hand, these banks are more willing and able to lend. This new capital then trickles down, funding startups, enabling corporate expansions and fueling job creation. This strategic buying and selling allows the central bank to fine-tune the money supply, ensuring the economy has just the right amount of fuel to sustain growth without sparking the fires of inflation. Finally, we have the reserve requirement, a fundamental rule governing the banking world. Think of a bank's vault, which must by law hold a certain percentage of its depositors' money in reserve. Unable to be lent out, this requirement acts as a safety net, ensuring the bank can meet withdrawal demands. By adjusting this percentage, the central bank can either tighten or loosen the reins on lending. If the reserve requirement is lowered, a larger portion of the bank's assets is freed up. This unlocked capital can then be lent out to individuals and businesses, stimulating economic activity and encouraging investment. A higher requirement has the opposite effect, restricting the amount of available credit and applying the brakes to an economy that might be growing too fast. It's another lever to control the flow of money, a foundational tool for maintaining the stability of the entire banking system. Through the masterful use of these three tools, adjusting interest rates, conducting open market operations, and setting reserve requirements, the central bank navigates the complex currents of the modern economy. It's a continuous performance, a symphony of subtle adjustments and bold decisions from a high vantage point. The central banker oversees the thriving cityscape, a testament to a well-conducted orchestra where inflation is stable, employment is high, and the rhythm of commerce beats strong and steady.